Hello and welcome to the Business Standard Morning Show. I'm Nazia Iqbal and here's a look at the stories for the day.
What the world needs now is people who see healthcare a little bit differently. Because seeing a healthier world isn't far in the future. We're building it now. GE, building a world that works.
Voices warning of a possible recession in the United States are growing. Several economists and business leaders have joined the chorus, claiming the country could see a negative growth for the second quarter in a row. But there are disagreements too. US Treasury Secretary Janet Yellen has said that there is nothing to suggest that a recession is in the works. But what if skeptics turn out to be true? A recession in the US would have far-reaching consequences for the Indian economy, especially for the country's information technology sector. Let's examine how badly the Indian IT industry will be hit if the US indeed goes through a recession.
While addressing the 27th Annual General Meeting of Tata Consultancy Services, Tata Sons chairperson N. Chandrasekaran recently warned of a stagflationary impulse in the backdrop of the ongoing Russian invasion of Ukraine. However, he said that TCS was well positioned to leverage the demand for digital solutions in the present environment and that the company was engaging in India and across the globe to tap opportunities. Not everyone in the industry is so sanguine. In late May, Zoho co-founder and CEO Sridhar Vembu told a news channel that the prospect of a recession in Europe and the earnings misses by American retail giants like Target and Walmart should have Indian IT services firms worried. Vembu explained that since the IT industry was dependent on the US and European markets, it was very concerning to see recessionary winds. So, what is this exposure like? The US market contributes anywhere between 40% to 78% of the revenues earned by Indian IT companies. Tata Consultancy Services, Infosys, Wipro, HCL Technologies, and Tech Mahindra, which are the top 5 firms, have more than a 50% exposure to it. On 19th May, JP Morgan downgraded the Indian IT sector to underweight as it believes that the sector's heydays are over. The report said that rising margin headwinds in the near term and revenue headwinds in the medium term due to a potential macro slowdown meant that the sector's earnings upgrade cycle was behind us. At the same time, Kotak Institutional Equities had suggested that the recent correction in the sector had been mostly driven by 3 factors, which were increase in interest rates, fears of recession in key client geographies, and the risk to margins. The Kotak Institutional Equities note had said that what was priced into stock was risk to margins, but what was not priced in was economic recession. The markets have also reacted. Indian IT stocks have seen a sharp correction in 2022, in part because of worries over the drawn-out slowdown in IT spending in the US. In fact, the Nifty IT index has plunged around 25% so far this year. In particular, May turned out to be bad for IT stocks.
The problem with the Indian IT services is not with the revenue front because of because it's a multi-year contracts that the Indian IT services companies are signing. The deal pipeline remained intact and the growth and the demand scenarios remain intact. So I believe there is a correction in the valuation part in Indian IT services. We see that depreciation of the 10 to 15% of the valuation or the multiples that Indian IT services was demanding in the previous few quarters. I see that the correction is being done so far and likely to continue with falling markets, because excess liquidity is being fetching from the markets to the primary markets rather than being on the secondary. So that might create an uncertainty in the markets going ahead. So I believe that likely to go far unless until there will be stability in the macroeconomic conditions. Every investor should look into the value investing rather than investing into the across the sectors. I believe the value investing should consider companies those have the higher revenue growth momentum. Secondly, the execution part, how they are doing the execution, which means and controlling the attrition rate, retaining the employee, maintaining the margins.
On their part, IT companies see the pipeline for digital transformation deals staying strong for several years. Note that these deals have been driving the order books since the COVID-19 pandemic began. So, is the relatively strong 2022-23 growth guidance put forward by IT companies under threat now?
In a short to medium term, we do not see that it is going to create any challenge for the IT service providers at the moment, because their pipeline is full and they are doing well at the moment. And we are not hearing from our end customers that they have significant concerns about the recession, and the call volume is not at the moment high, which indicates that there is something happening which needs to be taken care at the moment. But having said so, we need to keep a close watch on what is happening and how it is unfolding. In a short term, it may not impact. In a long term, if it happens, then it may have some impact on the speed on the transformation which the providers are doing. But that impact, as of now, what we see is that going to be minimal and will not have a significant impact on the guidance and the forecast which they have made so far.
So when you look at the overall quarter one, and when you look at the H1 demands, the demands or the hiring numbers is a good reflection of how the revenue outlook looks like. Tech sector may not have a complete visibility to, let's say, 2-year forecasting or a 1-year complete forecasting in terms of demand, and in the past may not have done well at predicting. But I think H1 looks robust, very similar to what you saw last time. I think Q3, Q4, I think you will see some bit of demand pressure that might come in, and you could see some bit of revision in the guidance that some of the players might announce. Again, it may not be across the board, because there's a difference between some of the large players which have a differentiated end-to-end digitization offering or digital offering, versus, let's say, the mid-size, small-size players who are still building their offering. So Q3, Q4, I think our belief is that you could have some bit of revision in the guidance that could come here for the full year and for FY24 as well. What's also going to happen is there is a lot of inflation pressure that's coming in, while there is a recession fear on one side, but there's definitely going to be a lot of inflation in the US and Europe. And that is going to have some benefit for India, because a lot of those high cost jobs, it will be difficult for the US tech sector also to afford, and even the likes of Accenture, Capgemini, Cognizant will also start seeing a lot of wage hike pressures there, and that part of the jobs are still continue to going to move to India.
Tesla CEO Elon Musk recently said that he had a super bad feeling about the economy. In the past few weeks, Musk has also warned about the risks of a recession. Recent comments from executives, including JP Morgan Chase & Co. CEO Jamie Dimon and Goldman Sachs President John Waldron, have added to the gloomy outlook. Dimon had recently said that a hurricane is right out there down the road coming our way. However, coming on the heels of Jamie Dimon's economic hurricane remark, JP Morgan Chase & Co. Chief Economist Bruce Kasman said that there was little chance that a US recession was imminent. A recession in the US might not be their real challenge. Instead, it will be critical for IT firms to balance between the revenue and the margin impact. This is because margins will continue to be under pressure for the sector. This will be even more critical because revenue per employee has also started dipping.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
IT services exports to the US surged during the pandemic, offering respite to the domestic economy. Meanwhile, pandemic also gave birth to a fresh crop of social media influencers, whose clout continues to grow. People turn to them for tips on a host of subjects, including health, latest fashion trends, gadgets, etc. But of late, credibility of some influencers has come into question. E-commerce company Meesho sent legal notices to some social media influencers for allegedly tarnishing the image of the company. Our next report offers a peek into the world of influencer marketing.
Social media platforms drastically altered the way we socialize. But in recent years, their role has expanded beyond that of connecting us with our friends. Consumers are now exploiting these platforms for other use cases, like keeping up with the news on Twitter, getting product reviews on YouTube, or gaining an inside view of celebrity and influencer lives on Instagram. In fact, a study by US influencer marketing intelligence platform SiteQuick revealed that 50% of millennials feel that they know the influencers they follow on social media better than their friends. At least 78% of consumers said they discovered a new brand or product from an influencer. And according to an October 2020 survey by Rakuten Insight, about 72% of the respondents from the age group of 25 to 34 years in India admitted to following at least one influencer on social media. While there is no rigid classification, the category in which an influencer falls in is typically defined by the number of followers. Nano-influencers are those with a few thousand to as much as 10,000 followers, while micro-influencers have up to 100,000 followers. For macro, this number goes to 1 million. A mega-influencer would be someone with 1 million or more followers. They may not necessarily be celebrities. Brands leverage influencers to not only promote their products, but also to get their messaging across to consumers in an engaging visual format. Influencers have a big impact on consumers, especially millennials. And influencer marketing has democratized digital marketing. It is not just TV ads anymore. The time spent on social media platforms is going up, and so is the clout of influencers. They command a higher engagement rate than celebrities and enjoy people's trust too, and brands know it very well. But of late, a flip side of influencer marketing also seems to be emerging. Allegations are surfacing that brands are using influencers to not just to mold their better image, but to pull down their competitors too. As with any industry, there are a few bad apples here too. For such agencies, it is just another service they offer to brands for money. SoftBank and Meta-backed e-commerce startup Meesho recently got a taste of it. It took note of this after a startup executive on Twitter pointed out earlier this month that several influencers, in a seemingly coordinated manner, tweeted negatively about the company while tagging its investors. These posts accompanied a link to a news article about Meesho's cost-cutting strategies. Meesho claimed that some influencers acknowledged that the tweets were paid promotions while others deleted their posts. It has now asked the marketing agency's CEO to disclose on whose behest it was working and issue an unconditional apology. Two more startup executives revealed they were approached earlier this year to make negative comments about Meesho in lieu for money. A journalist too shared her observation that articles on Meesho often receive coordinated abuse from verified accounts on Twitter. Meesho's founder and CEO, Vidit Atre, claimed that paying influencers to peddle rumors against the startup has been happening for the last many months. The agency, which engaged the influencers for this alleged smear campaign and to whose CEO Meesho sent a notice, is reportedly based in Ahmedabad. It is one among the scores of such influencer marketing agencies that have cropped up across the country as brands look to reach 400 million social media audience. Lakshmi Balasubramanian, co-founder of Bengaluru-based influencer marketing firm Green Room, says that smaller influencers sometimes get paid through free products in return for promotional posts talking up a product or sharing their opinions after using a product. She says nano influencers can get paid as little as 500 rupees for a post that can go up to 5,000 rupees, whereas a micro influencer can make as much as 15,000 rupees per post.
They're technically people like you and me. If they go on Instagram and record their everyday activity. So if I'm interested in sports, I'm going to go every day and talk about my sports journey. And eventually there's a bunch of people who are interested in my content and they start following me. So their reliability quotient is much higher than a celebrity. See, earlier they used to do these smear campaigns in the form of guerrilla marketing, right? So if it's a cola brand will compete with each other and attack the other, or it's similar. It's called a smear campaign largely. Largely, it's not okay to do that, right? So even those cola brands did it basis the rules that were formed. So they could do X and could not do Y. So they would blur some stuff. Some of them still had litigations against them and all that. Until there are rules put down, this will also happen. These smear campaigns, I mean, if they're paid to do X, they'll be paid to do Y also. And this smear campaign happens, Meesho might not be the only guys. It's simply money. If you notice, there are about 100 new influencer agencies that have come up, right? Small agencies. So if I'm pass out from a college and I know about 50 influencers, there's a good chance I know a lot of micro nano, because a lot of people in colleges nowadays start accounts and make content. I will decide to start one small agency and find a couple of small brands that pay 20-30K for a campaign, and they have to sustain and survive, so they'll do anything. With regulation, I think a lot of this can be fixed. Fake followers was a problem, fake engagement was a problem. So analytics have come in, ways to find these fake profiles have come in. In fact, with a lot of influencers, actually all influencers, we make contracts or get them to sign terms and conditions where they agree that they will not abuse the brand.
Influencers who tweeted against Meesho for a price may have fallen afoul of the guidelines for influencer advertising in digital media issued by the Advertising Standards Council of India, which is a voluntary self-regulatory organization of the ad industry. Green Room's Lakshmi Balasubramanian says that in such cases, brands and agencies can be pulled up since policing hundreds of influencers involved in a negative campaign can be impractical. A report by Group M India pegged the size of India's influencer marketing industry at 900 crore rupees in 2021, growing at an average of 25% annually till 2025. Around 40% of this consists of nano and micro influencers. While the exact number of total influencers in India is hard to come by, it could very well run into tens of thousands, if not lakhs, with more being created every day. According to the Advertising Standards Council of India, or ASCI's guidelines, influencers are required to disclose any material connection between them and the advertiser by using any of the permitted disclosure labels. Material connection isn't limited to monetary compensation. Disclosure is required if there is anything of value given to mention or talk about the advertiser's product or service. The anti-Meesho tweets did not carry any such labels. Influencers are also advised to review and satisfy themselves that the advertiser is in a position to substantiate the claims made in the ad. ASCI CEO Manisha Kapoor told The Morning Show that the regulator has not been approached by Meesho so far, but if they do, ASCI would examine the complaint to the extent of its remit.
This is certainly not the first time that one has heard of a thing like this. I think there have been cases, which have come up, perhaps not in mainstream media, but one hears about it, and not just in India, but across the globe, where there is a suspicion that, certain influencers have been paid to talk negatively about a competitor's product. And I agree with you that, the format of influencer advertising makes it easier for brands to reach out and do something like this, which of course is not only completely unethical, but it is also misleading consumers, and therefore, it becomes actually a misleading piece of advertisement, which could even be taken up under the new Consumer Protection Act. Of course, it is a violation of the ASCI guidelines if one were to find out that the content of what was being said, wasn't true. and if that kind of misled consumers, then it's a violation of both the ASCII guideline and potentially also a violation of the Consumer Protection Act. So certainly, I think the buck really stops with the advertiser. In this case, whoever has made the payment to the influencers, because influencers, by participating and endorsing such misleading claims, are also liable. I think all these are forms of what we call disguised advertising, which impacts the consumer's ability to take an informed decision, and therefore it is misleading and it is not fair, for influencers to do that. And certainly, I think if you start noticing these kind of violations, 100%, people stop trusting influencers.
Manisha Kapoor also says that even one or two of these agencies engaging in malpractices give the entire industry a bad name. She suggests that the influencer industry, including players in the ecosystem, should step up and look at implementing a code of conduct for itself to keep the industry clean. The onus to nip this malpractice in the bud also lies on influencers. It will not just dent their image, but that of the entire influencer community as a whole. The trust they enjoy will erode, and brands may also stop coming to them for promotions. ASCII too should act tough against such incidents to instill confidence among social media users.
यार
मत पूछ यार, फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Internet commerce platform Meesho is reportedly eyeing early 2023 IPO. Meanwhile, equity markets snapped their 3-week winning streak last week after the Reserve Bank of India hiked repo rate to bring down inflation. Our next report delves into the key global events that investors will track this week and key levels to watch out on the benchmark indices. Markets snapped their 3-week winning run last week, marred by increased volatility after the RBI hiked repo rate by 50 basis points and raised inflation target for FY23. The sentiment weakened further as global markets stumbled ahead of the US Federal Reserve's monetary policy meeting this week. Meanwhile, last week the BSE Sensex touched a high of 55,832 early in the week and thereafter drifted to a low of 54,206 and finally ended the week with a loss of 1,466 points or 2.6%. The NSE Nifty shed 2.3% to 16,202 and the Bank Nifty dropped 2.2%. This week, all eyes will be on the US Fed's 2-day monetary policy meeting on June 14 and 15, where investors will track Fed Chair Jerome Powell's outlook on energy prices, inflation, and economic recovery. According to a Reuters poll, the US Fed is expected to hike interest rate by 50 basis points in June and July, with high probability of a similar rate hike in September. That apart, Bank of England and Bank of Japan are also slated to take interest rate decisions on Thursday and Friday respectively. Back home, markets will take note of crucial inflation numbers. The Consumer Price Index-based inflation for May will be announced on Monday, followed by Wholesale Price Index-based inflation on Tuesday. Technically, weekly trend for the Nifty has turned bearish, with its 20-weekly moving average slipping below the 50 WMA. The broader trend indicates that the index could slide towards 15,800 to 15,300 if the 50-pack index fails to cross 16,900 level. Against this backdrop, the NSE Nifty may test its support at 16,000 mark, below which the next significant support is at 15,800. Similarly, the BSE Sensex may swing in a range of 53,300 to 55,300, with support expected around 53,950 and resistance at 50,050. Among individual stocks, Bajaj Auto will be in focus ahead of its board meet on June 14 to consider share buyback. Besides, recently listed LIC India and Prudent Advisory will be on investor radar as the compulsory 30-day lock-in period for anchor investors will end on June 13 and June 17 respectively.
तुम इतना डर गए? अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Let's move on to a global tax agreement signed to end the world's tax heavens. The pact was signed by over 137 countries to enact global minimum corporate tax on multinational companies to discourage them from shifting profits to low-tax countries. But a recent UN report claims that the tax will reduce the effectiveness of low tax rates and fiscal incentives to attract investment in developing countries. Watch our next report to know more.
Corporate tax avoidance costs countries anywhere from $100 billion to $240 billion annually, equivalent to 4 to 10% of global corporate income tax revenues, according to the estimates from the Organization for Economic Cooperation and Development, or OECD. Developing countries are disproportionately affected because they tend to rely more heavily on corporate income taxes than advanced economies. The existing international tax rules are based on agreements made in the 1920s and are today enshrined in the global network of bilateral tax treaties. But they present two problems. The first is that the old rules provide that the profits of a foreign company can only be taxed in another country where the foreign company has a physical presence. But in today's digitalized world, multinational enterprises often conduct large-scale business in a jurisdiction with little or no physical presence there. The second problem is that most countries only tax the domestic business income of their MNCs, but not foreign income, on the assumption that foreign business profits will be taxed where they are earned. The growth of intangibles like brands, copyright and patents, and companies' ability to shift profits to jurisdictions that impose little or no tax means that MNC profits often escape taxation. This is further complicated by the fact that many jurisdictions are engaged in tax competition by offering reduced taxation and often zero taxation to attract FDI. The OECD G20 Inclusive Framework, which has 140 members, was mandated to provide a solution to these two problems in 2021. And in October that year, 136 countries and jurisdictions, representing more than 90% of global GDP, including India, agreed to a landmark deal on a global minimum tax rate for companies. Known as the two-pillar solution, it ensures that large MNCs pay taxes where they operate and earn profits. Each pillar addresses a different gap in the existing rules that allow MNCs to avoid paying taxes. Members of the Inclusive Framework have set an ambitious deadline of 2023 to bring the new international tax rules into effect. Under Pillar 1, 25% of the residual profits of about 100 of the largest and most profitable MNCs will be reallocated to market jurisdictions where the company's users are located. Residual profit is defined as the profit in excess of 10% of revenue. Pillar 1 applies to multinational groups with an annual global turnover exceeding 20 billion euros, which can be potentially reduced to 10 billion euros after 7 years, and profit before tax greater than 10% of revenue. Each year, taxing rights on more than $125 billion of profit are expected to be reallocated to the countries where MNCs sell their products and provide their services, where their consumers are. Pillar 1 also entails the removal of digital services taxes and similar relevant measures to prevent harmful trade disputes. Meanwhile, Pillar 2 provides a global minimum tax of 15% on corporate profits. This will apply to multinational groups with annual global revenues of over 750 million euros, and as such, thousands of companies will be subject to it. Governments across the world will impose additional taxes on the foreign profits of MNCs headquartered in their jurisdiction, at least to the agreed minimum rate. This means that if a company's earnings go untaxed or lightly taxed in one of the tax havens, their home country would impose a top-up tax that would bring the effective rate to 15%. Governments could still set whatever local corporate tax rate they want. A carve-out also allows countries to continue to offer tax incentives to promote business activity with real substance, like building a hotel or investing in a factory. The global minimum tax is expected to generate around $150 billion in new global tax revenues annually. The cumulative impact of the two pillars means that tax havens would no longer exist, since taxes avoided in the haven would be collected at home.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Meanwhile, legislators in the US are finding it difficult to get approval in Congress. Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.